The U.S. economy just suffered its worst decline in manufacturing since the pandemic. And the question is, could this be a leading indicator of what's to come? In the Great Recession, 2007, we saw manufacturing lead the recession and then worsen during it, much like the damage that we're starting to see now. In the dot-com bubble, it really took the bursting of the, well, frankly, dot-com and telecoms region to reduce manufacturing and semiconductors. You had less of a broad manufacturing decline, but a lot of people are wondering now, is the manufacturing economy in the United States sending us a warning signal? Well, this morning we did get the S&P PMI numbers, so we're going to go through those and we'll add some commentary. Keep in mind, even though right now we've got Bitcoin knocking on the door, actually just over 99,000 now, and we've got Tesla, one of the greatest manufacturers really in the world, but also in the United States, a little pricey right now, but sitting at 351, up 3.5%. Qs are positive. Enphase, who uses contract manufacturing, also up 4%. You got bonds again down about 1.8. Gold also up 1.4. At the same time, you got oil up 1.4. So a lot of people are scratching their heads going, is this really a strong economy? Is this going to last? Or are there problems brewing that allow the stock market to rise while gold and oil also rise and bond yields come down? Well, it'd be really interesting. But the easiest thing to start with is get into the PMI report and also pay attention to that inverted yield curve. Well, uninverted. We're only uninverted by 4 basis points right now. So technically, we're not close to a recession right now. Usually see that between 50 and 90. But let's take a look at this first. This is the S&P Global PMI release. We got this data this morning, and I wanted to read you some of the quotes from the actual analysis. A strong and accelerating expansion in the U.S. contrasted that of a stalling expansion or even slowdown in Europe and Japan. But what led that in the United States? You're about to find out. U.S. businesses contrasted with gloomier moods in Europe, suggesting this growth divergence could widen. Things could keep going in the U.S., and things could worsen in Europe. You'll also see why. Key to the divergence has been a substantial outperformance of the U.S. services economy relative to other economies. But at present, the U.S. goods producing and manufacturing section is actually reporting a steepening downturn. Now, even though that downturn is less bad than what you're seeing in Europe, thanks heavily in part due to tariff uncertainty, I want you to see this line, this paragraph right here. A fall in manufacturing output was meanwhile common amongst the G4 economies, with the Eurozone registering the steepest decline out of all of them. However, the U.S. received, or the U.S. notably recorded its steepest manufacturing decline for 2 years, registering a significantly steeper pace of contraction relative to the modest decline seen in the US and Canada. Now, that's not great, but there's more data to get here, and then we'll make some conclusions and try to draw some understanding out of this. So service is doing okay, and we want to know what this is doing to prices as well, and manufacturing is getting whacked. And we see this as a very unusual divergence. You can see here, upside means that the service sector is growing more, downside means the manufacturing side is growing more. And we're at some of the highest levels we've seen since the summer of 2023, which this could be our first hint to trying to understand what's going on here. Why are services booming like this? Well, frankly, a lot of folks believe it almost all has to do with spending on artificial intelligence. That companies, almost every company, is hiring consultants left, right, and center to consult on how can we implement AI into our business to run it more efficiently. Unfortunately, that comes with a risk. The more people you're hiring for AI services, business services, consulting services, AI infrastructure services, whatever, finance services, you name it, the more you might end up with the same conclusion. Each company needs fewer workers, and unfortunately, more people are potentially prone to layoffs. Not great. But at least right now, the good news is the United States is outperforming its peers. We're outperforming the United Kingdom, Europe, Japan. And a lot of this really has to do with fear, recently at least, with fear regarding tariffs. Other countries are really worried about how are tariffs going to affect them. And even though tariff uncertainty is affecting U.S. consumers, here's a survey, the first survey since the election, suggesting that post-election confidence has declined somewhat. In 2016, when Trump won, you didn't see this decline. So it's a little weird that confidence fell a little bit by consumers and that their short-term inflation expectations actually declined, although longer-term ticked up a little bit. Right now, our inflation expectation is at the lowest level since December of 2020, which is really good, right? Lower inflation. In fact, if you go over here to the S&P report, you'll actually see selling price inflation cools, especially sharply in the United States. The good news out of the U.S. flash PMI didn't stop with output and future expectations, as inflation pressures also cooled. Average prices charged for U.S. goods and services, in fact, barely rose, registering the smallest monthly gain in the S&P global PMI this side of the pandemic, even though you had slight increases in the Eurozone and UK. So let's try to put all this together for a moment, because it's a little confusing. We're talking about the steepest decline in manufacturing. We're talking about prices stalling out, which is good. We want that. And services still crushing it, especially around the AI booms, release of Blackwell over here. You know, Supermicro is blowing up just like we kind of thought it would. Remember, if you're not part of the meetkevin.com/alpha report, it's totally free. You may as well get that over there. But this is not good. It's some of the worst manufacturing numbers. And look, manufacturing may only be about 10.2% of US GDP, understandable, but a lot of manufacturing leads services. The more we manufacture, the more consulting, install services we need, finance services we need, lending services we need, you name it. Now, of course, the manufacturing industry is going to be a bit more exposed to higher interest rates. Higher interest rates do have the potential of crimping the manufacturing industry because, you know, people don't want to buy cars or washing machines. You know, these are durable goods. People don't want to buy capital infrastructure like larger machinery, CNCs, whatever. And when you don't do that, you know, we actually saw ASML come off some of their high peaks lately because it seems like some of the, peak euphoria on equipment purchasing has really stalled. I mean, look at ASML. It's almost down 50% from its highs. That's crazy. It's not quite that high, but let's divide it here. 673 is the new divided by the old. It's down 39%, almost 40%. That's a lot. That's a big decline, and part of that is because of what you're seeing in manufacturing and this lower desire for tooling, basically. So how do we put this together? How do we reconcile this? Well, I think the easiest way to start by reconciling this is to tell you a little secret, okay? I'm going to let you in on something. So we're going to talk inflation, we're going to talk manufacturing, we're going to talk recession, we're going to talk services. We're going to talk about that in just a moment. We already talked about, and you already know this, so this is old news. We already talked about meetkevin.com/alpha to get your alpha report. We already know about that. But what you don't know about yet is that Kevin's not the biggest, don't tell anyone this, okay? Kevin's not the biggest fan right now of public markets. I think public markets are mostly overvalued, and that's why what I'm looking for are private companies that can really make a lot of money in either a soft landing or a recession because they've got strong balance sheets and can really pull us through as we get to likely higher layoffs. And so what I've done, don't tell anyone, I've quietly launched robohack.ai. Okay, don't tell anyone. Robohack.ai, it's a venture capital firm. It's only open to 99 investors. That's an SEC rule. It's not mine. Go check it out if you want. Okay, what does this mean for everyone else? Well, you have to understand this. In the dot-com bubble, just for history, dot-com bubble, you had a manufacturing decline, really more so follow the dot-com burst, right? So think about it kind of like valuations popped, then manufacturing plummeted, okay? In the Great Recession, you actually had manufacturing lead declines as a sort of barometer of economic certainty. Because I want you to think about this for a moment. What is the most bullish thing a business can do? Well, frankly, it's to buy machinery that will take 5 to 10 years to pay back, right? To actually start making an ROI on, like one of those ASML machines. Okay, what is the most bearish thing a biz can do? Well, I mean, it's frankly the opposite. It's don't buy machinery. So business confidence, leading business confidence about the next 2 years is dictated often by manufacturing. And this is why people say manufacturing leads GDP more than services do. What leads services? Well, frankly, strong earnings. So these are things that already happened. And then, of course, so not just strong earnings at businesses and companies, but also higher valuations. You have more to spend, and services can be cut rapidly in a slowdown, right? End the contract. Pay a little early termination fee or whatever, it's over. It's really hard to do that when you just took delivery of a $500 million machine and you're like, JK, I don't want this anymore because we're going into recession. So this is why people find that manufacturing is such a leading business confidence tool, because it tells you that there are serious concerns. Now, is it possible, possible explanation, maybe fear over tariffs, right? Maybe, possible explanation. But what's something else that's also possible? Well, it's frankly possible that as EPS levels off, earnings per share levels off at companies, the consulting that they've been doing in services leads to layoffs, which then crushes consumer spend and consumer services. That's recessionary. That's possible. Usually, though, you don't have to worry about this until the stock market corrects. So usually not an issue until market corrects. So keep that in mind. Not an issue until the market corrects. Oh, by the way, on RoboHack, just to be clear, this is like robotics, AI, nuclear. This is like, these are all new venture capital investments. Yeah, just want to be clear about that. It's not like it's like, oh, more HouseHack. HouseHack has its own fundraise going. And HouseHack isn't in any of those categories right now. I just thought I'd clear that up. But anyway, so this inflation, this sort of price decline is expected. In fact, this is why I'm so bullish bonds, because I don't really see inflation coming, and this S&P report reiterates that. Yeah, you had a little bit of volatility with the port strikes and sort of front loading before the holidays. That's normal. But I will say this is something to watch, because think about it. Manufacturing already in worst decline since pandemic. If stock market peaks and starts falling, for 3 to 6 months of red, layoffs will follow, and recession will be guaranteed. The problem is right now, even though we're sort of ripe for that correction, there's just no indication that you're definitely going to have one, because you just don't see the black swan right now. It's the nature of that. Now, I mean, some of the things you could look at is, you could go in here and go, okay, well, the S&P 500 has peaked out a little bit. It's been sitting here for about a week to 10 days. Those are the Qs. The S&P 500, same thing though. You've kind of peaked out about a week ago. You look at a company like Meta, you also see it's peaked out a little bit. Nvidia probably peaked out yesterday on earnings, and now it seems like people are taking profits. I mean, it's down 3%. Better opportunities right now seem to be Supermicro bouncing off the bottom over here, and Enphase finally starting to bounce off the bottom here. Both of these creating their first green candlestick. I did buy into both of those, though. I was just saying, these are like very, 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 very cheap companies, in my opinion, and they don't have some of the euphoric pricing built in. Some people think that, once Bitcoin crosses 100, that's it. Everybody goes profit taking. Otherwise, some people say it's just going to keep going on forever. I don't know, but what I can promise you is every single day I will be providing you, when the market's open, or maybe on the weekends if there's breaking news, I will provide you a report over at meetkevin.com/alpha. That report is totally free. Go to meetkevin.com/alpha. I'll text or email it to you, and you'll get lots of insight. Like this morning, I was talking about the potential for a Tesla breakout and a super micro breakout. Both of them did. I was more confident that super micro would break out. I didn't actually think Tesla was going to get to 347, but I said, watch it, because if it does, it's going to pop and it's going to start trending towards 414. And that's exactly what's happening right now. So if you want that sort of intel, make sure to pay attention to that alpha report. It's totally free. Go to meetkevin.com/alpha and get signed up. And if you want to learn more about that VC opportunity, go to robohack.ai. Thank you so very much for being here. If you're still watching this, I love you and appreciate you. And this is what meetkevin.com/alpha looks like. Cool, folks. Thanks. See you. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.